So the first part of the chapter covered the foreign exchange market. We learned why foreign currencies have to be denominated in prices, which is the exchange rate. Now we need to keep track of the flow of goods and services that are going between countries. So that is what we use the balance of payments for. All the balance of payments is a record of a country's trade in goods and services and financial assets with the rest of the world. In other words, if we're sending goods and services, then they have to be paying for them. So in other words, we have to include the financial assets also. The way that we keep track of the balance of payments is through what we call double entry bookkeeping. So those of you that are accounting majors should be very familiar with this, and we won't get too deep into it. I just want you to know that that is the general format that we use when we are calculating the balance of payments. And when you're using double entry bookkeeping, you have every single transaction is recorded twice. You have a debit and you have a credit, and the debits and credits always have to equal each other in order to balance out. So here I have an example of what we mean when we say that every single transaction has to be recorded as two accounts. So there has to be a credit and a debit. So let's say, for example, that the transaction we're talking about is a U.S. farmer exporting wheat to Canada. Let's say a Canadian buys $50 worth of wheat from a U.S. farmer. Well, that would be recorded as a $50 credit for the export that took place, simply because that export gives rise to the inflow of money. At the same time, let's say that the way that the Canadian paid for that $50 of U.S. wheat is they liquidated a $50 U.S. Treasury bill, and so then that transaction would be recorded as a debit as the financial outflow of the funds to pay. So we won't be going into any double entry bookkeeping in the context of this chapter. I just want you to understand that that is the method that we use, and that every transaction is recorded that way, where there has to be a credit and debit in each of the different accounts that we're going to be discussing. Now, the way that you know how transactions are going to be recorded is as to whether they are bringing money into the country or whether they are taking money out of the country. So any transactions that are taking money out of the country, those are going to be recorded as debits. So think about every time you buy something that has been imported. In other words, that money is not staying here in the U.S., it's going to purchase a good from a foreign firm. So those would be transactions that would be recorded as debits. Whereas any transactions that bring money into the country, those are going to be recorded as credit. So just like in my previous example, if a firm is exporting goods to another country, then that's bringing money in, and it's going to be recorded as a credit. So again, just to reiterate that every time you have a debit and a credit, they're going to have to balance and equal each other. Now, there's three major accounts in the balance of payments that you need to be familiar with. There's what's called the current account, the financial account, and the statistical discrepancy account. So the current account is the sum of some sub-accounts. We have what's called the merchandise account, the services account, the income account, and the unilateral transfers account. So we add up the net balances of each one of those individual accounts, and that gives us the total value of our current account. The financial account is where we record the flow of the financial assets and international investment into and out of the country. Now, the current account and the financial account theoretically should balance each other out. In other words, if you have a positive balance of $100 in your current account, you should have a negative $100 in your financial account, so that they add up to zero. In the real world, that does not always happen, so we have to create what's called our third account, which is the statistical discrepancy account, sometimes called errors and omissions, to account for any transactions that got overlooked or were not accurately recorded by the government, so that we can make the current account and financial account balance. And I'll walk you through an example of that in just a second. Now, like I previously stated, the current account itself is made up of 4 sub-accounts: the merchandise, services, income, and unilateral transfers account. The one that you're probably most familiar with or have heard about is what we call the merchandise account, because that's where we record all of the transactions in terms of actual goods going between countries. It's often referred to, or the net balance of the merchandise account is often referred to as the balance of trade. And so I don't want you to confuse the balance of trade with the balance of payments, because the balance of trade can have a positive or negative balance, whereas the balance of payments cannot. So the imports, any time that we import a good into the country, that is going to be a credit. In other words, that means that the other countries are buying our goods, that's bringing money into our country. Whereas every time, I'm sorry, I said that wrong. And every time, got ahead of myself, I was thinking of exports. Every time we import goods and services, that's money leaving our country, I'm sorry, so that's recorded as a debit. Whereas every time we export something, then that means they're buying American goods, so that is recorded as a credit. And so, of course, you would do the exports minus imports to see what your net balance in your merchandise account is. If you have a negative number, that means your country's running a deficit. If you come up with a positive number, that means you have a surplus. So each one of these individual accounts can have deficits and surpluses. It's just the entire balance of trade that has to be completely in balance. But the individual accounts, we know, that's not going to happen. So for instance, right now in the United States, our merchandise account has a deficit. In other words, the balance of trade is negative, where we certainly import way more than we export. Now, the second component of the current account is the services account. So anytime that, think of this as the tourism, any money spent on travel, transportation costs, insurance premiums, anything where you're spending money but it's not an actual good, it's a service. Those transactions are recorded in the service account. And the same thing, you have debits and you have credits. Money spent by foreigners here on services, those are going to bring money into the economy, so it's a credit. But anytime Americans are spending money on services outside the United States, that's going to be a debit. And currently our services account is running a surplus. We have more money coming into our services from foreigners than what we're spending outside of the United States. So again, that was our second account. The third account is our income account, and this is investment income and employee compensation. And then our fourth account is the unilateral transfers. So this would be including gifts to and from foreigners. Unilateral transfers are basically just where one party gives something but gets nothing in return. Another good example of a unilateral transfer is a retirement pension. So if you go retire in another country, that becomes a unilateral transfer. Now, the account that has to balance out the current account, recall I stated, was the financial account. So this is where trade involving financial assets and international investments are recorded. In other words, this is where we record how all of the payments are being made. And we have a couple of examples here. So some examples of foreign purchases of financial assets or real property would be like land and buildings, or domestic purchases of foreign financial assets and real property. So we just record all of our, trade involving financial assets here. Now, if we add up the value of all of the sub-accounts that were in our current account, so we add up the merchandise account, the services account, the income account, and the unilateral transfers account, then we can see overall whether our current account itself is running a surplus or a deficit. If it is a surplus, then that would mean that we have more money flowing in, but if we have a deficit, then that means that we have more money flowing out, or in other words, the debits are exceeding the credits in terms of the double entry bookkeeping. Generally, the United States in recent years has been running current account deficit. So if you look at our current account balance here that goes back to the 1960s up to about 2012, you can see that from about 1980 on, we were running huge current account deficits, meaning that we have to borrow money. Our financial account has to run a surplus in order to finance those deficits. And so what that's done is made the United States a very large, what we call net debtor. In fact, at this time, we're the largest net debtor in the entire world. What a net debtor is someone who owes more to the rest of the world than it is owed. Whereas if you're a net creditor, then that means you actually run a surplus in your current account, and so you have more money flowing in, and you're the one doing the loaning. Now, because our balance of payments always has to balance out to zero, remember that means that if you're running a deficit or a surplus in your current account, you have to be running the opposite in your financial account. So here we see a simplified table for the U.S. balance of payments in 2013's third quarter, and notice that we have a deficit in our merchandise account, which again comes as no surprise. We know that we import more than we export. We're running a surplus in our services account. We're running a surplus in our income account, and we're running a deficit in our unilateral transfers account. So we add up those four sub-accounts and see that we come up with roughly a negative, $105,896,000,000. So we're running a huge deficit in our current account. So theoretically, that means we should be running the exact opposite in our financial account. However, notice that the value in our financial account is only $40,422,000,000, which means we have some discrepancies there. In other words, there are obviously many transactions that have not been accurately recorded. Therefore, in order to make them balance, we have to take the difference between the current account and the financial account and create that same value in our statistical discrepancy account. So notice that if we add up the value of the financial account to the statistical discrepancy account, that gives us a positive $104,896,000,000, which will balance out the negative $104,896,000,000 that we have in our current account. So again, the net balance always has to be zero, and the way that we make that happen is by creating the statistical discrepancy account. Now let's say that I gave you a balance sheet and I wanted you to solve for one of the accounts. So you'll notice here that I'm looking at the simplified U.S. balance sheet, but I don't give you the value of the income account, and I'm asking you to solve for the value of the income account. So you would just think of this as basic algebra. In other words, you're solving for X. We know that the current account balance is going to be equal to the sum of the four sub-accounts: merchandise, services, income, and unilateral transfers. So we would just want to do that math out to see what we come up with. So you'll notice that's what I have written down here. We have the merchandise account plus the value of the services account plus X plus the value of the unilateral transfers account, and that should all add up to the value of your current account. So when I add up those other three accounts, what I come up with is negative $155,776,000,000 plus X equals negative $104,896,000,000, and then I just do the last step of the math where I want to get rid of the negative 155 on this side, so I'm going to add it to this side to get rid of it. And so now it crosses out over here, and then of course that means I have to add it over to this side of the equation. So positive 155,776,000,000. So when I add that amount, the positive 155,776 to the 104, the negative 104, what I'm going to come up with is 50,880. So now I've solved for X, so now I know that is the value of my income account. Now again, I can do the same thing. Let's say I gave you another problem and I wanted you to solve the value of the financial account. So again, we know the financial account should equal the current account, the opposite. However, notice that we have a statistical discrepancy account, which means they did not balance. So I just need to know the difference between the current account and the statistical discrepancy account to know what the value of my financial account is. Because remember, the value of the current account plus the financial account plus the statistical discrepancy account should add up to be 0. So in this case, I have a negative 104,896,000,000, but then for the statistical discrepancy, I have a positive 64,513,000,000. So in other words, I need to figure out what else do I need to add to this to make this equal 0. So I'm going to take the difference between those numbers to figure that out. So we can see that in order to get a net balance of 0, I would still need to add another positive 40,383,000,000. In other words, if we add 64,513 to 43,83, we come up with a positive 104,896. And so that way, then we come up with a net balance of 0.